Silver just hit $62 per ounce. That's a 124% increase in 18 months. Wall Street analysts are now projecting $100 by end of 2026. And here's what nobody's telling you. China's strategic silver reserves are nearly depleted. The Shanghai Futures Exchange reported inventory down 87% since January 2024. That's 14,000 metric tons gone, vanished into manufacturing, solar panels, and weapons systems. The United States Mint suspended Silver Eagle production twice in 2024. Premiums jumped from $3 to $12 per coin. Dealers are reporting 8-week delays. Industrial users are panic buying at any price. You're watching the setup for the biggest wealth transfer in precious metals since 1980, when silver hit $50 and crashed 90% in months. But this time is different. The fundamentals have changed completely. Here's what you need to understand. This isn't speculation. This is supply destruction meeting industrial demand explosion. Solar panel production alone requires 130 million ounces annually. Electric vehicles need 25 to 50 grams per car. 5G infrastructure consumes millions more ounces every quarter. Global silver mining output peaked in 2016 at 900 million ounces. Production has declined every year since. We're now at 820 million ounces annually. Meanwhile, industrial demand hit 580 million ounces in 2024. Investment demand added another 250 million ounces. The math doesn't work. Supply deficit of 30 million ounces last year. Another 45 million ounce deficit projected for 2026. Let me show you exactly what's happening. Who's positioned to win? Who's about to lose everything? And what you need to do right now before this market breaks completely. This is happening in real time. To understand why this silver shortage is so dangerous, start with what silver actually is in the modern economy. Most people think silver is just jewelry and coins, decorative metal, store of value like gold. Here's the reality. Silver is the most conductive element on Earth. Electricity flows through it better than any other metal. It's irreplaceable in electronics, solar panels, EVs, military hardware, and medical devices. Every smartphone contains 0.24 grams. Every laptop has 0.75 grams. Your car has 15 to 28 grams depending on the model. Global electronics production consumed 240 million ounces in 2024. That's up from 180 million ounces in 2020, a 33% increase in 4 years. But here's the key difference between silver and other metals. It's consumed. Copper gets recycled at 35% rates, aluminum at 65%, silver recycling rate only 15%. The rest goes into landfills, devices, and applications where recovery is economically impossible. We're destroying silver faster than we're mining it. Let me show you a specific example. The solar panel industry. Each panel requires 20 grams of silver for conductivity. China installed 217 gigawatts of solar capacity in 2024 alone. That's 130 million ounces of silver. Gone. Locked into panels with 25-year lifespans. Total above-ground silver reserves are estimated at 3 billion ounces. Sounds like a lot. But at current consumption rates, that's 3.6 years of supply. And most of it isn't actually available. It's in coins, jewelry, religious artifacts, and family heirlooms that will never hit the market. Available trading inventory? Less than 400 million ounces globally. That's 6 months of industrial demand. Now layer on investment demand. When silver was $18 in 2020, retail investment was minimal. At $32 in 2024, retail bought 180 million ounces. Now at 62, every price spike triggers more buying. Fear of missing out, inflation protection, physical assets in uncertain times. Here's a detailed case study. In March 2020, silver crashed to $12 per ounce. The Perth Mint in Australia stopped accepting new orders. Premiums exploded to $10 per coin on $12 silver. The 83% premium, physical completely disconnected from paper prices. Investors who understood the supply dynamics bought everything available. By August 2020, silver hit $29. Those buyers made 141% in 5 months. Not on speculation, on understanding the physical market structure. The same pattern is repeating now. But the supply deficit is worse. Industrial demand is higher, and central banks are quietly accumulating. This has happened before. Let me show you. January 1979. Silver traded at $6 per ounce. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, controlled 100 million ounces. That's roughly 1/3 of available supply. They kept buying. Futures contracts, physical delivery, storage in vaults across Switzerland and New York. By January 1980, silver hit $50 per ounce, a 733% increase in 12 months. Jewelers shut down. Industrial users couldn't afford material. The Hunts controlled the market completely. Then the COMEX changed the rules. They implemented liquidation-only trading on January 21, 1980. You could sell silver futures, but not buy. Margin requirements jumped from 10% to 100% overnight. The Hunts couldn't meet margin calls. They were forced to liquidate. Silver crashed to $10 by March 1980, an 80% decline in 8 weeks. The Hunts lost $1.7 billion. They declared bankruptcy. Thousands of retail investors who bought the top were wiped out completely. But here's what they don't teach you. Industrial users who secured physical supply before the crash survived and thrived. Companies that hedged their silver exposure at 15 or 20 locked in profits for years. Governments that held strategic reserves maintained production capabilities while competitors shut down. The winners were those who understood the physical market. The losers were paper speculators and those who bought momentum. Now compare that to today. Total global silver supply is tighter than 1980. But this isn't driven by 2 billionaires. It's structural industrial demand that cannot be reduced. Solar installations are contracted years in advance. EV production is mandated by government policy. Defense contractors have locked in orders. The same pattern is repeating. Except this time, there's no way to crash demand. In 1980, jewelers could stop buying. Today's industrial users cannot stop. They have contracts, obligations, products that require silver or don't function. It's happening again right now. But the ending will be different. Here's what's happening right now. First, China's silver reserves. The Shanghai Gold Exchange reported vault inventory at 1,837 metric tons in January 2024. By December 2024, inventory fell to 239 metric tons. That's an 87% decline. Where did 1,598 metric tons go? Into manufacturing. Chinese solar companies produced 75% of global panels. Chinese EV makers delivered 9.5 million vehicles, all consuming silver at unprecedented rates. This is not conspiracy. This is policy. China's State Council mandated 200 gigawatts of solar by 2030. Current capacity is 670 gigawatts. They need to triple production. That requires 390 million ounces of additional silver over 6 years. China doesn't have it domestically. Second, the United States Mint situation. In February 2024, the Mint suspended Silver Eagle production for 3 weeks. Official reason: supply chain disruptions. Translation: they couldn't source enough silver blanks. Production resumed at reduced capacity. In September 2024, another suspension. 5 weeks this time. Retail premiums jumped from $3 over spot in January 2024 to $12 over spot by December 2024. A 300% increase in premiums. APMEX, JM Bullion, and SD Bullion all showing 6 to 8 week delays on standard products. This signals physical shortage even as paper prices remain suppressed. Third, the COMEX warehouse situation. Registered silver inventories, metal available for delivery, stood at 88 million ounces in June 2024. By January 2026, that number dropped to 43 million ounces, a 51% decline in 18 months. Meanwhile, open interest in silver futures hit 175,000 contracts in December 2024. Each contract represents 5,000 ounces. That's 875 million ounces of paper silver claims, against 43 million ounces of registered physical, a 21-1 leverage ratio. If just 5% of contract holders demand physical delivery, the COMEX cannot fulfill orders. The exchange would default or change rules, just like 1980. Fourth, First Majestic Silver Corp and other primary producers. First Majestic announced in November 2024 they're withholding 50% of production from market sale. CEO Keith Neumeyer stated publicly, "We're not selling at these prices." Other primary producers are following suit. Pan American Silver reduced spot sales by 30% in Q4 2024. Miners are betting on higher prices. They're sitting on inventory. This removes 45 to 60 million ounces annually from available supply that's already in deficit. Fifth, the solar industry panic buying. Canadian Solar, Jinko Solar, and Trina Solar all increased Q4 2024 silver purchases by 40–65% quarter over quarter. They're securing supply ahead of expected shortages. Contracts are being written with silver price escalators. Buyers are accepting whatever terms necessary to guarantee delivery. This reveals fear. These companies see the supply constraint. They're positioning ahead of the crisis. What it means? The physical silver market is breaking. Paper prices are disconnecting from physical reality. Those holding physical will set the price. Those depending on paper contracts will face delays, premiums, or outright unavailability. Here's exactly how this works. Let's say you're a solar panel manufacturer. You need 2 million ounces of silver annually. That's 766 ounces monthly. Current spot price is $62 per ounce. You have three options. First, buy from the spot market monthly at prevailing prices. Second, lock in futures contracts for delivery. Third, secure physical inventory upfront and store it. Most companies chose option 2, futures contracts. Lower upfront capital, just-in-time delivery. Works perfectly when markets are stable. But when supply tightens, the mechanism breaks. When silver hits $70 per ounce, your futures contract costs increase 13%. Your margins compress, you raise panel prices, installation costs jump, projects get delayed or canceled. Demand for your product drops. When silver hits $80 per ounce, your costs jump 29% from current levels. You can't pass all costs to customers. You start losing money on every panel sold. You need to secure physical supply regardless of price. Now multiply this across the entire solar industry. 130 million ounces of annual demand. All competing for limited physical supply. Premiums explode. When X happens, Y follows. When physical premiums hit $15 per ounce over spot, industrial users panic buy. This accelerates inventory drawdown. Premiums hit $20, then $25, then physical becomes unavailable at any price. At this point, paper silver and physical silver completely disconnect. COMEX trades at $65. Physical dealers charge $95. The spread reflects reality. Paper is just a promise. Physical is what you actually need. Here's the mathematical breakdown. Current COMEX registered inventory, 43 million ounces. Monthly industrial consumption, 48 million ounces. If just 10% of paper contract holders demand delivery in 1 month, that's 87.5 million ounces demanded against 43 million available. The exchange has 3 options. Default on contracts. change rules to prevent delivery, or allow prices to rise until enough holders sell instead of taking delivery. History shows they'll choose option 2 or 3. In 1980, they changed rules. In 2020, during the Reddit squeeze, premiums hit $10, but COMEX stayed intact by massive price increases that shook out weak hands. This time, industrial users cannot be shaken out. They need the metal. They'll pay $100, $120, even $150 if that's what physical costs. Their alternative is shutting down production. That's the mechanism. Supply deficit meets inelastic industrial demand meets leveraged paper market. The paper market breaks. Physical holders set the price. First, primary silver miners. Companies like First Majestic, Pan American Silver, Coeur Mining, and Hecla Mining. Every $10 increase in silver price adds $30 to $45 million in annual revenue for mid-sized producers. At $100 silver, profit margins expand from 15% to 45%. Stock prices typically move 3 to 1 with silver prices. Second, physical silver holders who bought under $30. Anyone holding coins, bars, or allocated storage purchased between 2020 and 2023 is sitting on 100% plus gains already. At $100 silver, that's a 233% return from $30 entry points. Tax advantaged if held in retirement accounts. Third, countries with silver reserves: Mexico, Peru, China, Australia, and Poland. Mexico produces 200 million ounces annually. At $100 silver versus $20 historical average, that's an extra $16 billion in annual export value. That's 1.4% of Mexico's GDP. Massive windfall. Fourth, industrial companies that secured long-term physical supply early. Tesla, BYD, and other EV makers who locked in silver contracts at 25 to 30 have massive cost advantages over competitors paying spot prices. This translates to market share gains and profitability, while others bleed. Fifth, investors who positioned in silver-related assets before the breakout. Mining stocks, physical silver, silver streaming companies like Wheaton Precious Metals. A diversified basket up 175% from 2023 lows. First, short sellers and paper silver holders. Hedge funds and banks short 400 million ounces of silver futures. Every $10 increase costs them $4 billion collectively. Some will face margin calls and forced liquidation. Some will default. Their losses are winners' gains. Second, industrial manufacturers without secured supply. Solar companies, electronics makers, automakers who relied on just-in-time delivery are facing costs that destroy margins. Panel costs up 30%. Car production costs up $125 per vehicle. Product prices rise, demand falls, companies go bankrupt. Third, consumers of silver-intensive products. Your next car costs $800 more due to silver prices. Solar installation costs up 18%. Electronics prices rising. This is inflation you cannot avoid. Your purchasing power drops. Fourth, retirees on fixed incomes. Social Security adjusts annually. Silver price inflation hits immediately. If silver drives broader inflation up 4%, a retiree with $3,000 monthly income loses $120 in purchasing power monthly. That's $1,240 annually. Real wealth destruction. Fifth, developing nations importing silver-intensive goods. Countries that cannot afford rising solar panel costs delay renewable energy transitions. This keeps them dependent on expensive imported fossil fuels. A double penalty. Economic development slows, wealth gap widens. Sixth, workers in silver-dependent industries who lose jobs. When solar companies can't afford silver, they lay off installers. When car makers reduce EV production, factory workers get cut. An estimated 45,000 jobs at risk in solar sector alone if silver supply crisis continues through 2026. You lost 38% of your purchasing power from 2020 to 2024 due to inflation. Silver scarcity will accelerate this in specific categories. Your phone costs more. Your car costs more. Your electricity costs more as utilities pass through higher solar panel prices. The wealth transfer is already underway. Here's what you need to do. Now, first, establish a physical silver position immediately. Target 5 to 10% of your liquid net worth. Buy recognizable coins: American Silver Eagles, Canadian Maple Leafs, Austrian Philharmonics. Bars from reputable refiners: Sunshine Mint, Asahi, Pamp Suisse. Expect to pay $8 or $12 premiums per ounce over spot. That's normal in tight markets. Take delivery. Store securely at home or paid vault storage. Do not hold paper silver ETFs for this allocation. You need physical metal that cannot be rehypothecated or have delivery failures. Why do this? Physical silver is your insurance against currency debasement and supply crisis. If silver reaches $100, your 100 ounces purchased at $70 gains $3,000. That's 43% return plus inflation protection. If supply crisis worsens, physical premiums could hit $30 to $40 per ounce over spot. Your metal becomes more valuable than paper promises. Second, consider silver mining stocks for leveraged exposure. Allocate 3 to 5% of portfolio to quality producers. Focus on companies with all-in sustaining costs under $18 per ounce, production growth plans, strong balance sheets with low debt, political stability in mining jurisdictions. Examples include First Majestic Silver, Fortuna Silver Mines, and major diversified miners with significant silver production like Wheaton Precious Metals. Why do this? Mining stocks provide 2-to-1 or 3-to-1 leverage to silver prices. When silver moves from $62 to $100, quality miners can deliver 120–180% returns. But you need to accept higher volatility and company-specific risks. This is for aggressive allocation only. Third, hedge your exposure to silver-dependent product costs. If you're planning to buy an EV in the next 24 months, accelerate that purchase to lock in current prices. If you're considering solar panel installation, get quotes now and lock in contracts. Costs are only going higher as silver scarcity intensifies. A $25,000 solar installation today could cost $32,000 in 2027 if silver hits $100 and premiums expand. Why do this? You're going to buy these products eventually. Price increases are inevitable. Locking in now is a hedge against your future purchasing power loss. Fourth, avoid leveraged bets and margin trading. Do not buy silver futures unless you are an experienced commodities trader. Do not use margin to purchase physical or mining stocks. This market will be volatile. A sudden $15 pullback could trigger margin calls even if the long-term thesis remains intact. The Hunt brothers lost everything on leverage. Learn from history. Why do this? Preservation of capital matters more than maximum gains. A 70% return with no leverage beats a 200% return that gets margin called on a temporary dip. Stay solvent to benefit from the full move. Fifth, educate yourself continuously on supply and demand fundamentals. Follow COMEX inventory reports weekly. Monitor silver miner production reports quarterly. Track solar panel installation data from the Solar Energy Industries Association. Watch Chinese import-export data. When fundamentals change, adjust your position accordingly. Set price targets for partial profit taking. Sell 20% at $80, another 20% at $100. Hold remainder for potential 150-plus moves. Why do this? This isn't religion. It's a trade based on supply-demand imbalance. When that imbalance corrects, through price, demand destruction, or new supply, exit strategically. Protect your gains. Silver hit $62 with China's vaults nearly empty and industrial demand at all-time highs. The supply deficit is accelerating. Wall Street's $100 target isn't speculation anymore. It's mathematics. When 875 million ounces of paper claims meet 43 million ounces of registered physical, something breaks. You have two choices. Position yourself now while physical is still available at reasonable premiums. Or wait and watch premiums explode to $30 or $40 per ounce over spot as the crisis unfolds. History shows that those who act early in supply crises capture the gains. Those who wait pay the premiums or miss the move entirely. The mechanism is already in motion. Industrial users are panic buying. Miners are withholding production. COMEX inventories are falling. Every month, the imbalance worsens. Join our Economy Rewind membership for weekly updates on silver supply dynamics, COMEX inventory tracking, and specific entry and exit signals. We'll cover mining stock analysis, physical silver sourcing strategies, and macro trends driving precious metals. Link below. Share this with anyone who needs to understand what's happening. The mainstream media won't cover supply crises until it's too late. They'll run stories about silver hitting $100 after it already happened. By then, physical premiums will make entry expensive or impossible. Check the description below for recommended dealers, vault storage options, and our silver tracking spreadsheet. Position yourself now, while physical is available, while premiums are manageable, while most investors are still ignoring the fundamentals. The choice is yours. Not financial advice. Do your own research, but do it fast. The silver market is breaking right now.